there are certain principles that matter in accounting. Okay, these are not these are kind of abstract concepts that are going to inform the more nitty gritty rules. Okay, so let's just go through them. I think it's important. You need to understand why the rules are the way they are, and it's because of these principles. Number one, the cost principle. Let's say you bought a house 20 years ago for $300,000. You own it now. Has it gone up or down in value? Do we know exactly how much? Let's say I looked on Zillow, it says it's worth 600,000. Would it be fair to tell someone that my house is worth $600,000? Okay, so yes, technically it's correct that your house is worth approximately $600,000. You bought it for 300,000. It's gone up in value, but you don't know exactly how much it's worth until there is a transaction, until you sell it, until there's something that happens that exactly determines the value of that house. And until then, it's speculation. Okay. So this cost principle, we're only going to record things that our company owns. In this case, we're talking about companies, for what we've paid for it. And we are not easily able to especially increase the value of it. We're not easily able to say that this thing's gone up in value without some transaction happening. And so this principle is it's conservative, right? It does not want the company to have the ability to puff itself up. So that's why we're going to use the cost principle. So there's probably some, like MetLife, it's an insurance company. They own that building in Manhattan. They've probably owned it for like 100 years. It's on their balance sheet at some low amount, whatever they paid for it back in the day, because they never sold it. Yeah, but that's not a transaction. Appraisal is always also just someone's opinion. Yeah, there's exceptions. If we looked hard enough, but this is just the general principle. Okay, any questions on the cost principle? Everyone get it? Why it's conservative? Why it's the international standards? They allow businesses to reevaluate or revalue their assets without a transaction. So that's the big difference between the European standard and the US GAAP standard. Okay, so revenue recognition. Okay, so topic is a very hot topic in accounting. You can only recognize revenue when you've earned it. So this word earned is also very loaded. When has the company earned the revenue? And this is where a lot of the debate happens. But in general, we only want to recognize revenue when the company has sold the good that it's supposed to and ownership has transferred. It's provided the service that the customer is paying for. The service is completed, right? This is kind of generally the principle upon which we can recognize when a company's earned some kind of revenue. Okay, matching principle. You want to match expenses in the same period that a revenue is earned. Let's say you're like a convenience store, okay? In month one, you're gonna buy inventory, okay? Let's say you buy $100 of inventory, and we're gonna go into this in detail. I'm gonna kind of skip ahead. Our income statement, how we determine our profits is revenues minus expenses. And that's gonna give us our profit. So let's say in the first month we spent $100 on buying inventory. Okay, should it be 0 and show a loss of 100? And then in month two, let's say we sold it for 200. Do you think that's right? If you showed someone just your month two income statement, what impression is the person going to get of how profitable your business is? Is that like is it would they have an accurate picture of how profitable your business is? Why? What is it missing? This principle wants us to match up any expense related to the revenue that is generated. We want it to be in the same period. Because if you don't do that, you're going to have this kind of mismatch. Okay. This month one is also not accurate, right? Because you actually have this inventory sitting in your bill in your store, and it's going to give you some future benefit, right? You're gonna when you sell it, you're gonna recoup that cost, right? So as we're gonna see, we're gonna treat that as an asset first. Okay, and we'll define what an asset is. We're getting to that. Um, but we're gonna not expense that inventory until the revenue that's associated with it is kind of realized. My worker, that's just an expense I got to spend, right? There's no future benefit, right? I'm paying the worker to be there. So that would be in that first month, whatever I paid for my utilities, for my worker, that's not associated with the revenue, right? That's just what we call a period cost. It just in that 1 month, I had to pay that to operate my business. It's not associated with the revenue in the future. But we're going to learn there's many instances of, inventory is one. Let's say I have a delivery van, right? I paid $50,000 for it and I'm going to use it for 5 years. Should I expense all $50,000 in that first year? You have the van, right? And I'm going to be using it for 5 years, right? So what I want to do is spread that $50,000 across all the periods that I'm going to be using the van. So that's another example of this matching principle. We want to take what we're spending and match it in the period that we're getting the benefit. But again, for salaries, for utilities, I get no future benefit, right? I pay my workers for their time now, and if I don't pay them next month, they're gone, you know? So that's an example of a period cost versus a an expense that we have to match with the revenue. Okay, and we're gonna go into this. I'm introducing this stuff, but we're gonna definitely repeat a lot of this stuff, so you'll hopefully be clear. Okay, and then we have the full disclosure principle. This is one that says that all circumstances that would affect a user of the financial statement's decision making have to be disclosed. This can be used in a nefarious way by companies where they over disclose. They give so much information. I think it's called flooding the zone in kind of Gen Z language here. Companies do this. Enron, it's like a very famous kind of financial shenanigan kind of company that collapsed. They were flooding the zone. They gave so much disclosure that they actually disclosed the kind of shady stuff they were doing. It was just buried in like hundreds of pages of disclosures. But in general, a user, a investor, a lender is going to want to know all the things relevant to the business. Right? So that's what this principle is trying to get at. It's not perfect. We have to, there's some balance to it, but the principle is that you want your users to have all the information they need to make a good decision. And then the final one, conservatism. We will, in general, what does this mean in accounting terms? We never want to overstate assets. We never want to overstate revenue. And we never want to overstate equity. And when we talk about the accounting equation, this will become more meaningful. What you're saying is that you don't want to puff up the business more than what it's conservatively kind of worth or earning. And you're going to make rules that don't allow the company to do that. That's kind of what this principle is getting at. Okay. It's like under promise, over deliver, like that. That's kind of like the concept where you're okay with the company showing less profit or that its assets are worth less than they truly are, versus the other way where you're saying that they've earned more, their assets are worth more than they truly are. So you'd rather be wrong on the low side than wrong on the high side. That's what this principle and the rules that come out of that. It's like the R&D example, right? That's an example of this principle at work where the rules say that you just got to expense all of it. You're going to assume you get no future benefit.